Welcome to our tax planning webinar series. It's about that time of year where we all start planning for year end and preparing for the upcoming tax filing season. My name is Laurie Stiles, Marketing Coordinator HHM CPAs, and I'm joined by one of our dealership experts in CPAs, John Paul Davis. So would you mind introducing yourself?
Thanks, Laurie. Absolutely. I'm John Paul Davis. I'm the lead partner for our Management Advisory Services group. So we handle transaction support, mergers, acquisitions, business valuation, and litigation support for many of our clients. But we also specialize in the dealership space with projections, opening day balance sheet, controller support, and also OEM applications, just to name a few, some of the more salient projects we've handled in the past.
Awesome. Well, now that we know a little bit more about your background, let's go ahead and start talking about tax planning.
Well, before we do, I know this is a tax planning seminar, but I'd like to also note that not all year-end services or planning needs to revolve around tax planning. That's an important component of your year-end process, I know. But also, I just want to make sure that we also focus on the strategic plans for each company, and then also consider transaction planning in the dealership space.
All right. So we will take this in a different direction today. To get started, are there any acquisitions that are better than others, or what makes a difference?
So a lot of times, I find my dealer clients looking for a specific brand. They really want to be a Toyota franchise, or they want to get that Honda franchise, or they're looking for a fit within their existing portfolio. And while those are really good ideas, the way I like to think about it is just take a step back. And is that a tuck-in for your organization? So while it's important to look at brand and franchise as a mix in your group, it's also important to know about your culture spread, how much time you or your key employees will have at the new organization, and whether that will create some talent drain on your existing operations. So I think the way I would do it is take a step back, really consider your organization, where it's going long term, and plan that way. For instance, easy example, is this acquisition going to help strengthen your brand, really help your CSI, look at your real retail sales effectiveness, and help that application for when you're trying to get that better market store? So one thing to consider is just the impact on those incremental opportunities that are coming, and making sure that you think through the long-term consequences of adding a point to your group.
Okay. Wow, that's very helpful. So how do you base market valuation expectations when you are looking at the different options, considering the current economic conditions?
Great question, and it's all over the map a little bit. So I'm going to answer that somewhat broadly, if you will.
Okay.
So it's, let me answer it this way. It used to be somewhat simple, and you look at your trailing 12 months of EBITDA, you look at your multiples from the broker reports, and you can have a general good idea. But what do you do in market conditions where no one can agree on what grosses are? There's unprecedented amount of growth or profitability in certain products, and yet our capital structure is so different, with inventory shortages, used vehicle pricing being not what we're expecting, and not any real sense of when those market conditions are going to come back and go to pre-pandemic levels. So the way we look at it is, while we consider trailing 12 months and we consider prospective, we also balance that with 2019 or 2018 data, if you can, to temper projections and temper current market conditions. Really, if you just isolate your analysis on pandemic type profitability, you might be overpaying, you might be underpaying, but in our opinion, you're probably not valuing based on what really is that expected ongoing earnings capacity for that store.
Okay.
So long story short, factor in some historic if that helps you sort of analyze future. And then also just look at your margins, look at incremental items that you think are not going to continue in the future.
Okay. All right. Sounds good. So what are some general guidelines on how to estimate capitalization at an acquisition?
So there's three buckets, right? If you're going to buy a store, you're buying blue sky, the goodwill. You're going to buy the fixed assets, right? And then you're going to bring working capital. You're either going to buy it in terms of parts, you're going to buy it in some used vehicle equity, maybe some new vehicle equity. But then you're going to capitalize the store. So if you're looking at what do I truly need, don't limit what you're doing to just what's in your purchase agreement. Also think, I need to plan ahead for the right amount of working capital, considering that the manufacturer is going to use my projections and come up with the required working capital amount. We're working with our dealers all the time on estimating changes to working capital. low-hanging fruit, your used car planning volume, and your fixed expenses.
Okay.
So if you're projecting out a huge increase in used car, while that's possibly true, just keep in mind doing that will then increase your working capital requirements. So it's a fine balance of really looking at what's the appropriate amount of capital you need and tempering your projections.
So when you're in a transaction and you're about to apply for the application, what is it that the manufacturer is looking for?
Yeah, so your manufacturer, your OEM, they're very specific. It's their one opportunity to dig in, to ask the questions that they can't ask normally, because essentially you're asking them for the franchise, and they have the right to refuse, they have the right to take over that deal, and they have a right to say no. So it's important, a couple things. You have a set amount of time, so you want to make sure you have your ducks in a row, that you can submit a completed package in enough time that the manufacturer can review it, and can give you their opinion. If you're waiting and trying to send in documents here or there, you might get a statutory denial simply because they ran out of time. It's not a big problem. They'll just reopen it, but it does set you behind, and it never looks good with the seller. So things that the OEM is really looking for, they're looking at historical CSI. They're looking at your retail sales effectiveness. So if you're going in and I had this store and it didn't move the needle, I had some personnel changes, but I'm expecting to correct it here, and this is what I'm going to do. Have that on the front end. Put it out in a memo, add it to the miscellaneous documents. Help the manufacturer understand why some of your stores maybe weren't compliant, but you have a plan in place to get them to compliance. This really ties in with our first question. That sort of growth. What are the right kind of acquisitions and buy strategies? The consequence of buying a store that you're not going to be able to have, good CSI or retail sales effectiveness for whatever reason, market or whatnot, could be anchors in your next applications. So they're really looking at that. If it's an issue, plan ahead, be upfront, call it what it is. And then the other thing to look for is, on your funding side, be ready. If you're showing that you're going to have cash, the manufacturer's likely going to want to see 3 months of statements. They don't want to have just an influx of cash come in that's unexplained. So plan ahead. Have 3 months of statements. Line up your funding ahead of time. Sometimes you can look to your group for funding opportunities, either re-leveraging some stores or counting on cash flows from other stores. But it's important. Work with your CPA to kind of come up with a plan. How are you going to fund it? Tying in that working capital from a previous question. Tying in, if you have a bad apple, put it out in the front and explain it first.
So it sounds like being proactive is key in all
Plan
this.
ahead.
So we've talked about what to look for in acquisition, what the manufacturer is looking for in an application. So what can you do to prepare for a smooth closing?
Great question. So a lot of it is just preparing for the day of closing, where you have to present everything that you have and what's the price. So you're looking at inventory, making sure it's there. If you have a lot of service loaners, go ahead and either have the process of having them bring in the car, get the mileage, or let them know we might need to call them, might need to get the mileage, have the rental agreements in place. Just have a lot of these items where I'm selling this unit or this car, but I know it's not going to be here, so how are we going to wrap our arms around that? Then planning with parts inventory counts, having a good service, reputable, that's done this before, knows how to follow the language in your purchase agreement. Line that up ahead of time. What we like to do is we'll be there for our clients the day of closing. We're going to help build the schedules, follow the inventory pricing. I had a horror story of a client who purchased I believe it was a GM franchise, did not have the right language. We found out after the fact they bought it, and did not get any of the invoice discounts. And so this dealer stepping in at just invoice pricing for their new vehicles with none of the holdback, none of the advertising credits, being able to take advantage of that. The seller got them all. I mean, that puts you at a disadvantage from the beginning. So know your APA, know how to price the items. We'll help build out, flesh it out. We like to coordinate with the back office the week before, so we've got a planning as to responsibilities, who's taking care of what, who's going to aggregate and just have in place all the titles, the MCOs, so we can flip through those. And then really just having that team and coordinating, shutting down Sunday, closing on Monday, it's best practice. So what I would do is just reach out to your CPA, your advisor, and just start planning and making sure, have they done this before? Are they ready? Can they help?
Sounds great. It's a lot of great information, and I know we sidestepped a little bit from the tax planning, but I think this is very valuable, and really appreciate your time today.
Oh, you're welcome.
So
Appreciate the opportunity.
thank you for joining us. And if you have any questions about what we've discussed today, please do not hesitate to reach out to John Paul Davis or anyone here at HHM. We would be more than happy to help you.
And some of these questions can create additional questions, so please feel free, send in anything that you thought of while you're listening to the series, and we'd be happy to help and go from there.
Thank you very much.